Hey, welcome back. And in today's video, we're going to talk about how I'm betting on inflation. And no, I'm not investing in some stupid bond that the US government wants to give me, or gold. So with that being said, let's get right into it. Now, first let's start off with inflation being at the top of the mind of many households and investors. It's important to understand the ins and outs of how this will affect your investments. Inflation is not good for many companies, as it only serves to increase their costs, and they're usually forced to raise the prices of their products and services. And although most businesses do not want higher inflation, there are certain companies that benefit from sustained inflation, no matter the rate. And the companies that can benefit from inflation can do well in practically any environment and achieve market-beating returns at the same time. And in this video, I'm going to explain which companies those are and how I'm betting big on inflation. And the first one is payment processors. And although there are many payment processors out there, I'm going to focus on Visa and Mastercard in this video. Visa and Mastercard receive a small fee every time someone makes a transaction. And it's a pretty simple business model, but it offers a hedge against inflation in the long run, assuming it stays away from the hyperinflation territory, which that would destroy the entire economy most likely. Now, many investors may dismiss this thesis because they're not looking for an inflation hedge, but rather businesses that will outperform the broader market regardless of the inflation rate. And I think that this way of thinking fails to consider the difference between the headline CPI numbers and the M2 money supply expansion. Now, to go further into that point, the headline CPI is somewhere around 2%. Meanwhile, M2 money supply increases at 7%, with big credit events being the outliers, of course. With CPI consistently under the 3% in recent decades, many investors may see the rate of inflation as negligible. But if you see it as 7%, that becomes a very different story. And what I'm getting at here is that although many investors see inflation's impact on payment processors at a near 2%, it is actually much closer to that 7% mark. But that is not conveyed in CPI because of the way money is distributed in the economy when it's created. To explain how this phenomenon occurs, let's consider the way money gets distributed when it's created. When it is created, or printed, like many people say, by the Fed, it is usually used to either fund the government via debt or to bail out a certain industry, which often includes the banking sector. Now, when this money is introduced into the economy, more often than not, it is funneled into the larger institutions and the wealthier class as credit, which creates an increased sense of inflation. However, the majority of the newly created money doesn't fall into the mainstream items that CPI attempts to track. For example, if liquidity increases and rates begin to decrease, the upper 10% may take advantage of this lower rate and buy assets like houses, boats, luxury items, or stocks at lower rates, which stimulates the economy with the increased asset prices. However, that money would not translate into the cost of food or other CPI items to rise proportionately. Now, let's say you agree with this idea. Well, then payment processors are actually experiencing something closer to, but not 7%, rather than the lower 2%. Although the payment processors are heavily weighted towards the everyday consumer, there are still plenty of wealthy individuals who spend their money on the Mastercard and Visa network, which will skew that increase in payment volumes due to inflation from the 2% farther towards the 7% and land somewhere between the two. Now, personally, I am long Mastercard in particular because of many reasons, including but not limited to their ability to achieve a high return on capital employed and their steady, predictable growth of both revenue and profits. And I think this piece on inflation and its effects on these payment processors is yet another way to bet on the ever-expanding monetary supply that governments around the world continue to perpetuate. Now, there's also another type of business that I think can really take advantage of this ever-expanding M2 money supply, and that is indice businesses. Well, alongside the payment processors, there are also other businesses that can capitalize on the growth in the monetary supply, such as those who capture some of those inflows within their ETF or index funds. S&P Global is one of the most prominent companies in this space, as they own one of the most popular indices, namely the S&P 500. And the way they generate revenue from this index is by receiving a small fee for every dollar that is in an ETF tracking this index. There are also countless other spin-off indices like the S&P 500 Consumer Discretionary, Dividend Growth, etc. These spin-offs all contribute to S&P Global's revenue within their indices business. As inflation continues to grow and the money supply invested in these broad indices increases, the revenue generated will also increase at little to no cost to S&P Global. Now, although S&P Global's index business is a great way to capture the upside in inflation, it represents a small portion of their overall business, making up around 10% of their revenue. Therefore, it is not the main consideration when investing in a company like this. The rest of their business is focused on servicing data to various industries with a strong emphasis on financial data to aid investment decisions. For example, they provide all the data behind Yahoo Finance and many other platforms. Now, so what does all of this really mean? And in my mind, it's a hedge for my hedge. Now, let me explain. Well, most investors attempt to hedge their portfolios with gold, and even some are hedging against their currency devaluation with Bitcoin. But what if you could hedge against currency devaluation or inflation without having to delve into commodities or digital assets? By investing in companies like Mastercard, I think that you can take advantage of inflation while still investing in a profitable, growing business. And as someone who also has a fairly outsized position in Bitcoin, I've been looking for a safe but productive hedge for the possibility that my thesis does not come to fruition. I believe I found that in Mastercard and somewhat within S&P Global. Although I believe the long-term opportunity for outsized returns mainly lies within Bitcoin in relation to this topic, I do see a place for payment processors in my portfolio to reduce risk if Bitcoin does not manifest into the scarce store value for any unknown reason. And I think that this approach gives me the benefit of still investing my money where I feel the most conviction while also reducing risk and overconcentration. While for someone who is more risk averse, this is preferable. And I want to define risk here as not just volatility or the Sharpe ratio, but rather permanent loss of capital. Because as we've seen, Bitcoin is incredibly volatile, but has a very attractive Sharpe ratio and has outperformed nearly everything over its entire life. Now, although these businesses like Mastercard and S&P Global may be able to take advantage of the expanding money supply, the most common way that people attempt to hedge themselves against this is not through these companies, but rather through commodities like Bitcoin or gold. And yes, Bitcoin is a commodity. Gold has been tested over hundreds of years as being a fairly consistent store of value, with a few hiccups, of course, due to certain large institutions seeking to manipulate it. However, Bitcoin presents an increased opportunity and risk as it is not recognized as a scarce, stable store of value by all, resulting in large fluctuations as the debate on this continues. If we were to come to a point where it was recognized as a digital, scarce, gold-like asset, that would be a superior store of value, and the value would increase by most likely more than fivefold, presenting obviously a significant opportunity for those who see the inevitability of the M2 money supply expansion at an exponential rate across the world, not just within the US. And with that, that's all I had for you in this episode. I'll see you in the next one.